Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what is going on today. If you want to follow me, it's @_finance. And if you want to join our community, finding-value.com, you can see the coupon code, the special in the lower corner there. We have a question and answer session coming up on Sunday at 5 p.m. Mountain Time. If you'd like to go to the Q&A session, which is a Zoom meeting. All right, so first squawk, we got OPEC Plus is likely to make another oil output hike of 411,000 barrels per day for August when 8 members meet on July 6th, sources say. So they're releasing this information out, trying to get oil prices to keep oil prices down. This is a steady stream of news coming out to try to keep the pressure down on oil. As we work through the spare capacity of OPEC, then I think people's minds will get a little bit more bullish than what they have been. We're still squeezing up on oil, another one to think about in that corner. We haven't broken out yet. We're squeezing up in the right-hand side for both West Texas Intermediate crude and also for Canadian crude, which are the two that I follow. Smart Real Estate Bets, he says, I have uncovered a lot of statistical data about home price appreciation that blew my mind, and this was the first. Historically, median house prices have risen the most and by a wide margin in the era when affordability was worst, and the least when it was most favorable. Does that make sense? It does, because when I looked at the data looking backwards, what I saw was that home prices and interest rates go up together. There is a loose correlation. Now, if you look at eras where there were basically shortages of homes, that was highly true. If you take a bunch of the data that's kind of in the middle where things just go up and down randomly, then you want to kind of throw that data away. So put it this way: when there's a home shortage and home prices are going up in a strong trend, generally affordability gets worse the same time that home prices go up. We saw that in 2020, 2021, where prices went up with affordability getting worse. And historically, median house prices have risen the most and by wide margin in the era when affordability was the worst. But that makes sense, doesn't it? Because your largest, when you squeeze housing the most, and there's the largest disconnect in the market between buyers and sellers, you would figure that home prices move up the most, inflation is going to be coming into the system, and the largest disconnect is when interest rates are going up, not down. It's trying to cool the market. So it makes sense to me. But here it is: affordability versus price appreciation by era, 1972 to 2024. The median mortgage payment income ratio percentage. That's this side, and then by quarters here. You can see we had a big spike in early 1980s, of median mortgage payment divided by income ratio percentage. They were paying the largest percent of their income during that time frame. Was this time frame over here. Today, we're actually more towards the average than expensive or cheap. So when people say, "Oh, it's the most unaffordable time to be purchasing a house," it's garbage. It is not right. Now, if you're comparing it to this down here, which was one of the most affordable times in history to purchase, well then yeah, it looks expensive. If you compare it to history, it looks pretty average to me going back to 1972. Christine Guerrero says, just a friendly reminder that U.S. shale declines by 600,000 to 750,000 barrels per day each month. That's the volume needed to perpetually be replaced by active rigs and fleets simply to keep production flat. So the decline curve of shale is 600 to 750,000 barrels per day each month. That's ridiculous. And she's responding to the oil rigs in the Permian, which are still falling. They are still coming on down. So what I think is occurring is that we are losing oil probably in the Permian here soon, and oil will be replaced by maybe OPEC. And maybe Donald Trump is doing something with OPEC and saying, look, we'll cut you a deal, buddy. We need cheap oil prices, and the Permian can't deliver that. So how about we cut a deal with you? This is the exact opposite of drill, baby, drill. We are literally destroy, baby, destroy of our own Permian production and replacing it with Middle East oil. I don't know how great that feels to be replacing jobs in America with Middle East oil. Coming down, TD on copper. Copper must make its way into the LME to prevent legitimate fears of a stockout. The market has been wrong-footed by Liberation Day, expecting a sharp slowdown in demand, whereas our proprietary real-time estimates point to no evidence of a slowdown in commodity demand growth. Meanwhile, the threat of Section 232 tariffs on copper has been sucking copper inventories from the rest of the world. At the same time, as Chinese stockpiling has further sapped inventories from the world, now as LME inventories have reached critically low levels, time spreads have blown out, which should incentivize metal to flow back into the system. Shanghai traders have been in the offer of in the SHFE copper. If metal does not imminently make its way back into the system, legitimate fears of a stockout a la 2021 will reemerge. So that's the situation in copper. What's with this stockout stuff? I mean, why aren't prices higher? Why aren't we mitigating this in the markets today? I don't understand that. I don't understand if we are so efficient, why are we talking about a potential stockout? Does that mean that prices are being artificially held too low? Is the market that wrong here? I don't know. I just find it weird that we could get a stockout. Well, I mean, wouldn't prices just be rocketing higher now? Smart Real Estate Bets, another one. He says, the fact that younger consumers bemoan the wealth that boomers accumulated in homes bought 40 or 50 years ago is dripping with irony. Because if they were alive back then, they never would have bought a home. Demand for immediate gratification sets a high bar for home ownership. And again, this chart shows how mortgage rates have correlated to affordability. The percent of median family income required to fund mortgage payments on a median-priced house since 1972. No surprise, the correlation is very tight. So mortgage rates versus affordability. Higher mortgage rates, worse affordability. And affordability is the mortgage payment as a percent of the median income. Q1 2025, we are not at a high location. I repeat, we are not at a high location right now. High locations are up here. Low locations are down here. We're in an okay location. We're not even in an expensive location in terms of mortgage payments as a percent of median income. But everyone else is going to tell you that we are up here or expected to be way up there. That's what I would expect listening to some of the people on Twitter and YouTube when I read and see things. Everything's going to crash is what they always say. Rock bottom entries. Palladium is embarking on a generational run. PGM bull market inning 1 of 9 as we're starting to move on off support for palladium. Now, platinum's had a favorable ratio ever since this peak here. Platinum's come off the bottom. Palladium is lagging a little bit behind platinum. Now, some things that I've heard about palladium. I've heard that palladium's supposed to go into a surplus in the future. So a surplus for palladium and a big deficit in platinum. As things get revised, it is, at least people have talked about, that palladium will stay in a deficit longer. So perhaps that palladium staying in a deficit longer will also support the price of palladium for a while. I could see perhaps platinum and palladium running together, both moving up in tandem for maybe a long time. That is a possibility. And we'll see what the ratio does over time, if platinum outperforms it or not. U.S. rigs fell 6 to 432. It's a new cycle low, the lowest since October of 2021. So U.S. directed rig count is still falling. Still falling. Drill baby drill. When did he come out with that? That was what? Beginning, it was like up here, and this is what's transpired. Huge drilling going on. Totally believe these guys. Totally believe them. There it is. Baker Hughes rig count, -6 for oil, -2 for gas. This is a big piece of the crude products inventory pie. Way under store. Low inventory yields a higher price. Higher price works its way into a higher crack spread. Higher crack spread means more domestic demand from refiners. I don't even know how this is possible, guys. How are we down here at $65 a barrel and we are this low in our inventory? This is distillate stocks, lowest level for this week of the year, this century, down to 80% of the 5-year average. How are we down here with the price down? Make it make sense, guys. Is it being helped lower the price? And remember, lower prices increases demand, which will kick you out of the averages. So we're starting to see an anomaly with inventory levels and pricing, the size of the disconnect. Tom McClellan says, my latest chart in Focus article, inflation's 5.31-year cycle is bottoming, is posted at my homepage. Direct link to follow in a reply. And it looks like he's got this cycle potentially turning up for the CPI 12-month rate of change. JC Parrott says, failed breakdowns often precede the most historic breakouts. That's what I call the slingshot cheetah. The slingshot is where everybody gets off sides, a failed breakdown, and then squeezes them as it goes on up, which makes the historic breakout. The bigger the breakdown, the bigger the squeeze could potentially happen. And there's some big breakdowns that have occurred in some of these ratio charts. I'm going to show you one later here with maybe could be a historic breakout in the future. Warren Buffett, cash combined with courage in a crisis is priceless. Yeah, you steal all the shares when everybody is selling them in fear. Here's another one from Smart Real Estate Bets, and I'm going to read through this one real quick. It says, this chart shows how mortgage rates have correlated to affordability, the percent of median family income required to fund mortgage payments on a median-priced house since 1972. No surprise the correlation is very tight. Where quarter 125 falls will surprise most people, but the data is real. It's still pretty cheap. For all those who love to whine about how much boomers have made on homes they bought 40, 50 years ago, that red box represents when mortgage rates were greater than 10% from 79 to 1990. What's crazy is the rents were not nearly as expensive then as they are now. So these, we'll call them boomers, bought homes that were at a very expensive time in terms of affordability. And at the same time, they were at a relatively very low cost for rent affordability based on household income. So rent was incredibly affordable during that time frame. Houses were incredibly expensive, and they still made a killing on buying homes. Think about that for a second. Based on current thinking, people should call boomers fools for paying up so much to own a house when renting was dirt cheap by modern standards. The real estate wealth resulted from compounding appreciation and locking in fixed monthly costs. Short-term pain for long-term gain. That's exactly what I did. I wanted to lock in my costs because I thought and still think that we are in an inflationary move in the system. It is based off of the system design. So what I did is I bought a house a while back. I refinanced it in 2020, 2021 when it was down, and I locked in my costs. The real estate wealth resulted from compounding appreciation and locking in fixed monthly costs. It's exactly what I was doing and thinking. I was really fixated on reducing my costs with what was at that time my largest expense. Now it's not my largest expense, food is. Grady says, the precious metals ratio charts I have posted is your ticket out of the rat race. Fortunes will be made. This chart is saying the tide is turning. The capital rotation is in the making. The pink reversal pattern is now broken out and back tested. And this is First Majestic Silver divided by NVIDIA. Remember J.C. Parrott, what he quoted? Let's go up and I'll read it one time. He said, failed breakdowns often precede the most historic breakouts. Failed breakdowns often have the most historic breakouts. So this is a 15-year bullish falling wedge in the ratio of First Majestic versus NVIDIA. He says, as a proxy ratio chart for the two sectors, silver producer AG is extremely undervalued versus tech darling NVIDIA. He's expecting around the apex move, the apex of this falling wedge, the false breakout, and then the move around the apex higher. That's what he is expecting. Now, I think something like this is going to occur. The exact timing, difficult to time, to be precise. But if you can get it right and hold on to one of these, yeah, it's going to be historic. Absolute ridiculous returns if you can get it cheap and are able to hold on. That's the key to all this, being able to hold on. Kevin Bambro says, with ever strong rally in a commodity bull market, expect capital raises to come and destroy the rally. They trick out at first. Then there's a flood of them. Then there's always a few who don't get it done. My advice to crappy CEOs, the crappy company CEOs, ring the till and down, try to time it perfectly. Get her done. Here's another one from J.C. Parrott. He says, first, it was the industrials making new all-time highs. Then it was technology hitting new all-time highs. Now it's communications. Notice how the list keeps getting longer and longer, not shorter. Are we going to get that recession? It doesn't look like it. It doesn't look like it. Jenny Many Dots says, if you could give my summer student one piece of investing advice, what would it be? Be more patient. Be patient. Look for value. That's it. Look for value and be patient. If you find extreme undervaluation, that is what's going to protect you against downside risk, and it will give you upside asymmetry. And then extreme patience is what's required in order to make a lot of money. Kevin Bambro, so many commodities are breaking out over key levels on long-term charts. The world is clearly exiting US dollar reserves and seeking to lock in purchases or real assets. The huge deficits will have massive consequences. Inflation is just one of them. I see a whole bunch of stuff trying to break out or has broken out in commodities as well. I completely agree with them. Lynn Alden, nothing stops this train. I think she's talking about money printing. We'll probably just extend short-term debt. Nothing stops this train. You got to keep it going, otherwise the system doesn't work. Here's a platinum alert, and this occurs in big bull markets. NYMEX raises margin requirements on platinum futures by 25%, effective tomorrow, which is yesterday, when I'm reading this. Wow, this is the second increase within 2 weeks. What this does is it reduces leverage in the system. And then usually you see the price go down those days. It is a big hit to the price moving lower, in an uptrend. They're trying to slow the move of the price. They do this in silver and they're doing it in platinum. So be cognizant of this happening as we go through the bull market. Those big down days, like 4 or 5% down days, that doesn't mean that the move is done. It is generally, it could be occurring because of these margin increases. So it's a margin requirement, which is what they do, and they're reducing leverage. Big Four storage chart. Yes, I know I had to double take it as well. Look at this, guys. What the heck is going on here? U.S. Big Four storage, crude, gasoline, distillate, and jet fuel. How is this declining this fast? What is going on here? And how are prices still so low? I don't know. This is getting interesting. Pretty strong drawdowns occurring in the Big Four, which is a big deal. Prices should be going up, not down. And that's what I've got for today. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Specials, the coupon code over there. And that's all I've got for today. So we'll catch you next time, guys. And we've got a Sunday question and answer session coming up at 5 p.m. Mountain Time on Sunday. We'll see you later.